and I'm fairly familiar with these things, so we'll go ahead and get started. How much time do I have?
He's the last one.
You're the
on
last one, so until you're
Much
done.
as you'd like.
And all you guys, you saved me for the last, and now all these guys are just, they've eaten.
That's
trained all
right, that's
morning.
right. Don't let them fall asleep.
If you get a call on your cell phone, if it's important, go ahead and take it. It's not gonna be a problem with me. Before we get into the real estate part of it though, just a couple of things that are relevant to realtors and most business people, and that's the standard rates for mileage for 2021 and for 2022. You'll notice that for 2021, we dropped from 57.5 cents from 2020 to 56 cents for 2021. The reason for that, they always determine the rate based on the previous year's experience and the prices of oil and gas. So from 2020 to 2021, we had a bit of a decrease, but from 2021 up to 2022, well, for 2021, we actually had an increase in the price of gasoline. So that's why you're seeing a 56 cent to 58.5 cents increase in your standard mileage rates. That's good news for us who use our cars, all right? It's interesting though that for 2021, our standard medical and moving rate was 16 cents a mile. Of course, that's if you're moving your offices or your residence. It went up to 18 cents for 2022, but look at the contribution rate. 14 cents a mile last year, 14 cents a mile for 2022.
Yeah. That went up, but then the contribution rate get down.
Yeah. All right, so that just to let you know, that's where we're gonna be for last year as you prepare your tax return information for last year, and then as you prepare your expense reports for this year. So we've got, as we said in the introduction, a couple of major advantages that the Internal Revenue Service provides with regard to real estate. And they do that for a reason. Real estate is major market. Major market. Real estate impacts the entire U.S. economy. So as a result, there are some incentives that the government provides in the area of real estate. And I've seen this since I've been in accounting, and that's been 40 plus years ago. Most of you are aware that with the sale of a personal residence, we have exclusions on the gain of the sale of a principal residence. Exclusions. That means we don't have to recognize that gain on the sale of a personal residence if you meet certain requirements. And that gain that you can exclude on the sale of a personal residence is $250,000 for individuals. If you're married filing a joint return, that bumps up to $500,000 on the sale of a personal residence. That's what I call home sweet home. All right, now, I was thinking about this. You know, if a person was really, really bright enough and could anticipate market changes and really have an eye for the market, they could actually buy a residence, hold that residence for 2 years, live in it, enjoy all the benefits of it, and have that residence just explode in value and sell that thing for $500,000. They can do this every 2 years. And it's tax-free.
That's right.
You could do this for a living if you had that type of an eye. Think about $250,000 per year, tax-free.
Yeah.
That's the equivalent to about $600,000 a year. All right? Now, but to exclude the gain on the sale of a principal residence, the taxpayer must file Form 8949 as either a short-term capital gain, as a short-term or long-term capital gain for the portion of the gain in excess of the excluded amounts. Now, how do you determine that gain? Well, you look at the sale price and then you compare it with what your cost is. I don't know if I've ever had a taxpayer who actually had a gain, married filing jointly, that exceeded $500,000 on the sale of their personal residence. I've had some close, but none quite that high. Here's the key though. If your client is going to get a 1099-S as a professional, you better advise that client to report the sale of that residence on his personal income tax return. I have a friend who came to me just several months ago, and they had gotten a letter from the Internal Revenue Service. This friend's mom had a home that, because of her health condition, she had to move into a care facility, so they had actually rented out that home. Well, they held on to it for a couple of years, but they were able to sell it finally. And that sale from the proceeds from the sale of that residence were not reported on that mom's personal income tax return. So 18 months go by, everything's hunky-dory, and all of a sudden a letter comes from the IRS assessing about $87,000 worth of income tax for not reporting for this additional income that's been reported to the Internal Revenue Service but wasn't reported on that taxpayer's individual income tax return. So they panic, and normally when I have friends who panic because of income tax issues, they come to me. So I looked at it and I asked a few questions, and I drafted a letter and included a form that we went back to the Internal Revenue Service with. Now the problem is that because of the fact that the Revenue Service has been working remotely, and this is what I love about bureaucrats, okay? Most of the people who really have to work for a living have now gone back to work, all right? We're here today. Fortunately, I don't see a mask on any one of us, and that's for good reason. You're smart people. You're smart. You pay attention to the science. Well, how did I get to that?
You interjected, but you said that you sent the form to the IRS.
Oh, the IRS is working remotely still.
Remotely.
Also, all these bureaucrats that are drawing these big salaries from your taxes don't have the courage yet to go back to their offices where they can accommodate the taxpayers when we have issues. So the taxpayer keeps getting computer-generated letters about this balance due, and we're waiting for them to respond. And finally, after about almost a year, the daughter of that taxpayer came to me at church the other day and said, "Darrell, we finally got the letter and everything's cleared up." Okay. An interesting set of circumstances, though, because she had been renting this house. So how was she able to still claim that exclusion from taxation? Qualifying factors for excluding that gain on the sale of the personal residence. You have 3 tests: ownership test, use test, and benefit test. The ownership test says that the taxpayer must have owned the home for 2 of the previous 5 years. If the taxpayers file a joint return, only one spouse must satisfy the ownership test. So where's the benefit, especially here, with one spouse being able to satisfy the ownership test? What if you have 2 people, they both have a home, and then they get married? Pardon me? Well, no, the beauty of it is that you can actually realize that exclusion on one spouse with their home, wait another couple of years, and then sell that next house, and both spouses can realize that exclusion on their homes. That's the beauty of it. Only one spouse must satisfy the ownership test. All right? The second test is the use test, though. The taxpayer must have used the home as his or her personal residence for 2 years, 2 of the previous 5 years. If the taxpayers file a joint return, both spouses must meet this 2-year test. So we have 2 2-year tests here, all right? 2. I had a taxpayer that came to me this past tax season. Actually, the mom did. The mom had gifted her daughter a home out in Texas. And the girl, over the past 5 years, had lived in that home a couple of years, but she was presently up in Connecticut going to school up there. Actually, she was teaching in the school up there. She would have owed about $67,000 in tax, except for the fact that because she met that exception, we were able to get that tax liability down to around $1,300. So it's a lot of fun when you're working with income taxes and you can see those types of results. I can tell you some other results that are not so much fun, though. Finally, the benefit test says that at least 2 years you must have elapsed since the last sale for which the taxpayer used the exclusion. So if you jump back up to this, where 2 spouses or 2 individuals, they get married, each of them have a home, one of them sells his home and claims the exclusion, they have to wait then 2 years before you can claim that exclusion again. All right? Now, so what if you're out there and you're about to assist somebody in selling their home, but they've only lived in that home for about 18 months? What are you going to say to them? And this home has, and the reason they're selling is because now the home is so much more valuable than what it was. Mm-hmm. What are you going to say to them?
You need to talk to an accountant.
Well, you may want to, listen, you may want to wait another couple of months because you can exclude this $300,000 gain that you're about to realize that you're going to have to pay tax on if you don't. Now, I don't know about you all, but I can afford to wait a couple of months to save $300,000. In fact, I don't know if I've ever saved $300,000 on a single transaction. You know, of course, it would be the tax on that $300,000, but still, you're talking about some significant money. Exception. Remember this though. We're talking about 2 years of use. You can realize a reduced amount from the maximum exclusion if the taxpayer falls into one of these, if they don't meet one of these 2-year tests, but it's because of a change in employment, change in health, or unforeseen circumstances. What could be an unforeseen circumstance? COVID's everything's COVID now. Right? What about, pardon me?
Unemployment, we've had to do.
Yeah, well, we've got employment here.
Yeah.
All right.
Unfortunately.
What if you've got a married couple and they have a little cottage that's a 1-bedroom and all of a sudden they get the best news of all?
Triplets.
Absolutely. That is a change in circumstance.
Yeah, unforeseen. That's definitely unforeseen.
That's not what I was going to guess at all. They both triplets.
Miranda's
Okay.
expecting right now.
All right, so the qualifying factors, again, the ownership test, the use test, and the benefit test. Any questions?
Okay.
All right.
Oh, I do have a question.
All right.
Only because I'm going through this. I left your voicemail.
Did you return it?
Not yet. He was probably going to today. For how can the IRS determine if you actually live there as your primary residence for 2 of those 5 years?
Well, first of all, they can ask the taxpayer, or not ask the taxpayer, they can require of the taxpayer that they give them documentation of when that house was purchased and when that house was sold. And they have full authority to do that.
So,
Or they can look at tax records.
right. So, I'll just tell you. I have a house. It's now a rental property,
Okay?
but I did have it considered it my primary residence
Okay.
for up to 3 years ago. So this is my last year of having it as
Okay.
like that 2 out of 5.
Okay?
So would I just have to provide basically?
All right, we're
the
gonna get
rental-
there. We're gonna get there. Don't do anything with that house until we get to that slide.
Hold your breath.
It's sincerely, don't do anything with that house until you read the slide that's gonna be coming up. Here we are.
Commercial.
Look at this. A rental property acquired in a section 1031 exchange. Now, you have a rental property that wasn't acquired in a 1031 exchange, but you're converting that rental property to a personal residence.
No, vice
going
versa.
to
Was a
personal
convert it to pay
residence.
off my student loan debt.
It was a personal residence, now you're converting it to a rental
She
property.
moved away to
It is
another
now,
state.
yeah. It's a rental now.
Okay, well, you're good. You're good. We can get to that at another time in another conference. All right? But look at this. And we're gonna get into like kind of exchanges here in just a moment, but a rental property that's acquired in a section 1031 exchange may be converted to the use as the owner's personal residence. That's kind of, I thought that's where we might be
Okay.
going, all right? But if such property is then subsequently sold, the taxpayer may exclude that gain under section 121, which is the exclusion for personal residence, principal residence, all right? But look at this. The taxpayer cannot claim that section 121 exclusion within 5 years of the acquisition of the like-kind property. All right? So now we're in Baldwin County. And you've got a lot of activity going on in certain parts of Baldwin County. So if you have people, clients, who are looking at selling their personal residence, it's not a bad idea to inquire, how did you acquire this property? You didn't happen to get it through a section 1031 exchange, did you? And maybe they've only owned it 3 years or 4 years and they're looking at selling it? It's another good question to ask. Any questions about that?
So you're saying if this is, like, if this, somebody's personal property, not a rental, no, rental property acquired. So this is a rental property that they have, and they did a 1031 exchange, and that's how they purchased or paid for
That's how they
some
got this
or all
particular
of
property
it.
that they're living in right now. And
Okay,
they
and now
converted
they're-
it to a personal residence.
Okay, and now they're starting to live in it. Okay, I got it. Okay.
So they've got a 5-year holding period now.
Okay.
Okay.
So if you
Did
buy,
anybody know that before today?
No, I did not.
so if you buy a property with a 1031, you have to hold on to it for 5 years.
If you acquire that property through a 1031.
Okay,
Yeah, you said buy.
okay.
You're kind
Same
of
difference
acquiring.
in my
Yeah.
mind.
It's just a.
Sure,
But
yeah,
he's
you
talking
have
about
to-
converting
if you
it to
can-
a personal
But that's
residence,
converting it to
though.
a personal residence.
okay.
Not if it's a
Now,
rental
if
to
you
a rental
keep-
to a
If it's a
rental.
rental for a rental and you continue renting it, then if you look to sell it, you got a choice then to make whether you want to do another 1031 or if you want to do a just straight out sale.
Okay.
And we're going to see what the major impact of that is here in just a minute. All right, any questions here? All right, here's the major advantage number 2. We talked about the major advantage 1 was that the exclusion for the sale of a personal residence, correct? Your principal residence. Major advantage number 2 is the exchange of real estate. So we got this Irish Internal Revenue Code section 1031, and that's where we get this description of a 1031 exchange. It's coming from section 1031 of the Internal Revenue Code. It provides that for the non-recognition of gain or loss on the exchange of qualifying property that is used in what? A trade or a business or held for investment. Now that's important. Let's suppose that you've got a principal residence and then you have a second home over the beach. All right? There are certain rules to determine whether that second home is basically an income property or just a personal property. If you sell, or if you try to exchange that second home, that's really truly a second home, a personal property, it will not qualify for a 1031 exchange. Why? Because it's not meeting this requirement. Business, trade or business, or held for investment. People have tried to say, after living in a home for a period of time, that, well, my intent was for the property to increase in value, and then I was going to exchange it. Well, what were your practical treatment of that property? What was the practical treatment of that property? If you were treating it as a second home, second residence, it's not going to qualify.
But if they had rented that short term,
even short term that exceeded 10%, okay, of the time it was used, then yeah, it would qualify. You could prove that then. Generally, no gain or loss is recognized when business or investment property is exchanged solely for like-kind property. In other words, if it's trade or business, held for investment, no gain or loss is recognized at the exchange solely for like-kind business or investment property, other business, trade, or investment property. If the property that is not like-kind is received as part of an exchange, gain but not loss is recognized up to the extent of the non-like-kind property that is received. So what could that be? So if you've got property that is not like-kind property that you receive, or that is part of that like-kind exchange, and you can't recognize non-gain on it, what kind of property would that be? Well, we know it would probably be personal property. So what type of personal property are we talking about? Well, let's take, for instance, a condo over the Gulf, and you want to exchange that personal property. What is in that condo?
furniture,
Appliances, furniture. So those appliances and that furniture would not qualify for the non-recognition. Only the real property. We'll see some exceptions to that as we go through. Okay, like-kind properties, what do they look like? When I saw this and put this up there, I thought of the story of little Amy. Derek Johnson shares a story about this little girl. She's in a kindergarten, and she's frantically working on this picture. Crayons, just here and there, and it's getting time for her to leave and go home, and her instructor comes up to her and says, "Amy, what are you doing?" She says, "I'm drawing a picture of God." And the instructor says, "Amy, nobody knows what God looks like." And Amy brushes back her hair, takes a deep breath, and says, "They will when I'm finished." So what does like-kind property look like? What does it look like? Well, they're properties that have the same nature or character, even if they differ in grade or quality. So you could have a pristine piece of property and something that's really run down and ragged looking, and those two would qualify for like-kind exchange. For real property, like-kind is interpreted very broadly by the service, Internal Revenue Service. Any real estate can be exchanged for any other real estate and qualify for Section 1031 treatment if the relinquished property was and the acquired property is used in a trade or business or for investment. Inherently permanent structures are included as real property. Inherently permanent structures. What would we be talking about there?
actual, like, real estate, that's, I mean, it's attached to the ground, so it's a permanent
Okay,
structure.
let's talk about, all right, so you're right. What about built-in swimming pools? That's an inherently permanent structure. What about a bridge on the property? That's an inherent permanent structure. What about a generator that you have sitting outside your property that comes on automatically when the power goes out? That's an inherent permanent structure. So that qualifies as part of that like-kind exchange. The furniture in that house, no. But these inherent permanent structures, yes. So here's some examples of like-kind exchanges. City property for farm property. Improved property for unimproved property. You got land somewhere in Mobile County. You find a condo over in Baldwin County. You want to exchange it. Is that possible? Absolutely. Improved or unimproved. Look at this. An undivided interest in several parcels of real estate for a sole interest in a single parcel. So you could actually have multiple parcels of real estate that you could exchange for a single parcel and they still qualify. Certain timber interest, water rights, rights of ways, and conservation rights also qualify as interest in land. Look at this though. Time-limited interest in land are not always like-kind. For instance, if I have a lease on a piece of property, and I want to exchange that lease for a piece of property, piece of real property, is that like-kind?
Lease for purchase doesn't seem like it should be.
It depends. In order for that to qualify, that lease has to be in excess of 30 years. But if you have a lease that's 30 years, and you want to exchange that lease for a piece of property, you can. That's a like-kind property.
What about like fair single tax? Those are leases.
Well, that's and they're 99-year leases. All right, for the most part, yes, they would qualify. What if you had a lease though that was 27 years, and you had a piece of property that you wanted to exchange that lease for? What would you do? Renegotiate the lease. Get that thing up to 30 years, and you're home free. All right. That could be a real help to a potential client for you.
So if you bought a fair single tax property 80 years ago, and you've got, what would that be, 15
years
less
ago?
than 19 years left of your lease, would you have to get it
You'd have to make some type of
renegotiate the
accommodation there.
lease?
Yep. Yep.
The lease is renewed whenever you transfer it. On fair.
Yeah,
single
but-
Yeah,
tax
but if you
law.
got the lease and you're holding it, then you're gonna have, I'm sure they would work with you there.
I'm sure they would.
Fair single, that's its
Interesting.
own little thing.
Yeah, it really
Sure.
is, especially with regard to that single tax.
Uh-huh.
That's, yeah.
Any questions there? Everybody still awake?
Yes.
Let me know if I'm putting you to sleep. I'll talk a little louder. Okay, here are the mechanics of the exchange of 1031. Here's the basic meat. To qualify as deferred like-kind exchange, transaction must be an exchange of property for property. What does that mean? No cash can be exchanged in advance. In advance. So it's distinguished from a transfer of property for money. The taxpayer cannot actually or constructively receive money or property that does not meet the requirements of Section 1031 before the taxpayer receives like-kind replacement property. Now, before, it can be contemporaneously, and we'll get into that here in just a moment, but it can't be before. So, pursuant to an agreement with a qualified intermediary, we'll call this QI, the taxpayer transfers property held for productive use in a trade or business or for investment and subsequently receives property to be held either for productive use in a trade or business or for investment. The use of a QI, that, what is it? Qualified intermediary, effectively allows the taxpayer to sell the property and use the proceeds to purchase replacement property without the transaction being treated as a taxable disposition. There's your basics right there. Now, let's look at some more of this mechanics. So what's the role of the qualified intermediary? He facilitates the exchange and does not actually take title to the replacement property. So we mentioned that property has to move over to that intermediary. Well, we really don't have to deed the property over to him, but he has to basically be the purchase agreement has to be assigned to him. That contract has to be assigned to the intermediary. The seller also negotiates the purchase of the replacement property and then assigns the contract to the QI. The qualified intermediary then holds the funds until the exchange is completed. This is an absolute requisite in order to achieve successfully a like-kind exchange. But look at this. A qualified intermediary cannot be the taxpayer's agent, including anyone who was the taxpayer's employee, accountant, attorney, banker, broker, or real estate agent within a 2-year period before the transfer. The QI cannot be a related party to the taxpayer. All right? There are not a lot of lawyers who like doing like-kind exchanges. In fact, this is a pretty specialized area. There's a guy over in Mobile named Gilbert Dukes, and most of those like-kind exchanges just flow right through him. I don't know who it is in Fairhope, or Fairhope has anybody over here who's...
I used Gil Dukes.
Gil?
That's who I used.
Well,
That's it.
Gilbert Dukes. So they have an office here, and they have an office
Over
in
there
Mobile.
too.
So he's the guy.
Mm-hmm.
Listen, my son is a outstanding business attorney with Armbrecht Jackson in Mobile, and I had an opportunity. I thought I'd take him a little bit of business, and he said, "We refer all of our like-kind exchanges to Gil Dukes." And he's a good guy, really bright guy. By the way, his dad was a CPA. And I don't know what that means except for the fact that I'm a CPA. All right, any questions? All right, staying in the mechanics of the exchange, and you all are familiar with this. In a deferred exchange, the replacement property must be identified within 45 days after the taxpayer relinquishes the exchanged property. So you assign your purchase agreement over to the intermediary, and within what? 45 days, you have to what? Identify the property that you look to purchase, to exchange for, the replacement property. 45 days. Now, that's the first, 45 days. Within 180 days then, you have to receive the replacement property. All right? Within 180 days of the date that the taxpayer relinquishes that exchange property, then within 180 days, the taxpayer has to close on the replacement property.
So is that 180 days after the 45 days? When does the 180 days start?
What does it say? After the date the taxpayer relinquishes
So
the
after the
exchange property.
closing date.
Okay.
Relinquish
All right.
would be the closing date.
So when he, when he writes that agreement and assigns that agreement, because it's not closed yet.
Right. So
When he
before.
delivers that to the intermediary, that's when the 180 days starts.
Okay.
All right? But within that 180 days, he's got 45 days to identify the property.
Because I know my last 1031 exchange, they waited until we were after inspection and all that kind of stuff before they actually
That makes sense.
initiated
Because that
the
gives you additional
1031.
time. And
Right.
the additional time is important.
Yes.
It's hard to find property sometimes these days.
Yes.
And look at this. If the due date of the return, all right, so it's the earlier of 180 days or the due date of your tax return for that year. So let's say that you find you turn that your relinquished property over in November, and then you begin to search for the new property. But let's say that by the time the taxpayer return is due, you still haven't found a property. What do? Well, remember, it's the earlier of the 180 days or the relinquishment or the due date of the tax return. Earlier of 180 days from the relinquishment or the due date of tax return. So you get an extension on your tax return. All right, so that you could have that full 180 days to find that replacement property. Multiple properties can be identified, but you have to be aware of the stipulations. So you can actually go out and identify 3 different properties. But if you identify more than 3, then there are additional stipulations stating that the combined value of those additional properties can't be more than 200% of the property that you're relinquishing.
And I have heard that when it comes to condos, that you can identify a building, that you don't have to identify a unit. So like if you have a complex, they know they're gonna buy in there as soon as something comes up, if there's not anything on the market.
That's a gamble, isn't it?
That's interesting, because each of those units in that condo would be considered property.
I know, they're separate.
Yeah. So I'd have to do a little research on that
Okay.
to say, yes, that's correct. Identifying replacements. Oh, you identify a replacement's property by actually submitting a signed written agreement to the intermediary and to the other parties that are involved, which would be the seller of that property, right? There's also a reverse like-kind exchange. Has anybody ever done one of these? They're pretty complex. In a reverse like-kind exchange, replacement property is acquired before the relinquished property is transferred. So all of a sudden, you see a property out there that you really like. Well, you go ahead and identify that property, and it's acquired, but you can't acquire it. The intermediary has to acquire it.
What?
So that would be like Gilbert
Hold on
Dukes?
just a moment. Yeah, well,
That
yes,
he's the
yes,
intermediary?
but it's a modification. It's a slight variance to that normal. The IRS provides, though, a safe harbor for reverse like-kind transactions, exchanges. And under this safe harbor, if the property is held in here it is, April, a qualified accommodation arrangement, a QEAA. The IRS will not challenge the qualification of the property as replacement property or the qualification of the property as relinquished property. And the treatment of the exchange accommodation title holder is the beneficial owner. All right, so actually, this guy really has to take ownership of this thing.
Wow.
But he's excluded from having to recognize any gain or loss on it. All right? If you're electing a like-kind exchange, you have to be aware of all the requirements of the qualified exchange. And there are about 6 specific requirements that you have to meet. In this particular situation, you really need to seek professional assistance. I don't do reverse. I'm not even involved in those things. All right? Now, the basis. What is basis in a property? Basically, what is it? It's cost. It's cost. So if you hear people talking about adjusted basis, they're talking about adjusted cost. Gain or loss realized on a like-kind exchange is deferred, and I don't like this word realized here. I should have put another word in there. Gain or loss that's computed would be a better term, I think, because you're not realizing it, because you're deferring it, okay?
Sure.
There's a like-kind exchange. It's deferred because, why? Because the taxpayer's economic status does not change.
Yeah.
You got a property, your economic status is X. You get another property, your economic status is still X. You haven't sold this property and have an additional $340,000 in the bank because of the gain on sale. Your economic status is the same. Deferral is accomplished by carrying over the basis, and the basis is what? Cost. Carrying over the basis from the relinquished property to the replacement property. The basis, the cost of the replacement property, is the basis of the relinquished property increased by any cost incurred in the exchange. So, I've got a property that's worth $500,000. My cost in it is $50,000. I exchanged that property for another property. What is my cost or my basis in that new property? It's $50,000. Let's say, though, that I paid $2,500 worth of closing costs, and I paid another $500 worth of legal fees. And let's say I paid $40,000 worth of additional commission on the sale to that realtor. All right? So what is my adjusted cost now? It's the $50,000 plus the $2,500 closing costs plus the $500 to the attorney plus that $40,000 commission. All right? So that's how your basis is adjusted. Basis of the replacement property is also increased by any additional consideration paid or boot. All right? The basis of the acquired like-kind property is the carryover basis of the property exchange less the boot that's received plus the boot paid increased by any gain recognized and decreased by any loss recognized. That's easy to understand, especially this time of the afternoon. So let's do this. Let's go through an example. The owner has investment property in Mobile County worth $1 million. You got it? The owner's cost in that property is $100,000. The owner finds a condo in Baldwin County worth $800,000. And he wants that condo. And he wants to exchange his property, unimproved property in Mobile County, for that condo in Baldwin County. So the owner agrees to exchange his land for the condo and an additional $200,000 from the individual who's getting his property over in Mobile. All right? The exchange is a 1031 exchange. It qualifies. The owner is taxed on his gain to the extent of the $200,000. Why?
Because it's a
Because
profit. It changes
that's not
economic
like-kind
status.
property.
Right.
That's not, cash is non-like-kind property. And that's basically, well, his profit.
Mm-hmm.
His profit is really what?
Yeah, but he.
$1 million
But
minus the
he
100.
exchanged that, so he
Yeah.
had this extra
So,
200,000.
so this is the boot that he's getting, all right?
The boot.
The boot. Cash. The owner's 100,000 basis in the investment property becomes his basis then in the condo. But he has to report that $200,000 and pay tax on it.
So-
Long-term capital gain, so it's maximum 20% right now. But he still has to report that portion of it and pay tax on it.
Every 1031 I've ever done, they've gone up in the price for that reason, I guess. So like they would sell at 200,000 to go to 300,000, sell 300,000 to go to 400,000, so that it's,
Instead of going down, so
instead
that
of
they don't
going
have any
down.
taxable, yeah.
And keep in mind that any gain that you have that's related to the $200,000 actually reduces the basis in the property that you just purchased. All right. But in this particular instance, that $100,000 basis that he had in the old property stays the same unless he has some other types of expenses that he would incur. And if that were the case, then he would increase his basis by the amounts of those expenses. Any questions? Did you learn anything?
Yes. And I think
And
it's
I'm not even
important
gonna ask you to tell me what you learned. Okay?
For what?
I think it's important, like, I mean, he said, the one that was really complex,
The
seek
reverse.
professional.
Yeah.
Well, I think that across the board. Like, we need to be able to, as real estate agents, like, our job is to come to them with an educated understanding of what a 1031 exchange is, but we're not an accountant, we're not an attorney, and so we need to definitely stay in our lane,
But here's the thing, as professionals, you need to be aware
Exactly. We need to be able
of the
to.
benefits for
Right.
your clients. All right, you need to be aware of them. And yeah, it is complex.
It's a lot.
It is complex. But look, how impressive is it when you're talking to a potential client and they say, look, I'm looking at exchanging this.
Mm-hmm.
Gilbert Dukes is the guy you need to talk to.
Yeah.
How impressive is that?
Mm-hmm.
Just dropping a name of the guy who does 1031 exchanges in this area, in these two counties. That's powerful. That's powerful.
I've got his number if anybody wants it.
Yes, we need to, I can add it to this sheet.
And let me tell you what's neat about this. What's really neat about Gilbert Dukes?
Yeah.
His fee's about $500 to handle one of these.
Really?
You know why? Because he's got staff, and they're probably as knowledgeable of these things as he is. And when you call there, you're going to get a girl. His secretary's going to answer the phone. You're going to tell her, and she's going to start asking you questions, and then she's going to send you some information to fill out. So it's complex, yes, but it's affordable. He could be getting a lot greater fees than what he's doing, but he's covered up with business. Covered up.
Well, and two, I'll tell you, I had a client recently, a very, very smart client, and they own 2 investment condos. They have 1 condo they've not been happy with the rental management company, and she was like, I'd really love to sell it, but I don't want to pay the taxes on it. And I was like, well, have you considered doing a 1031 exchange? And I'm talking about, she's way smarter than me. And she was like, I don't even know what that is. What is that? And so I started talking to her about it. She, sought the advice of her attorney, and they decided to go ahead and sell it before they would have, because we 1031 exchanged and bought a new condo. So I got 2 sales because I just knew enough about it to be able to encourage her, hey, let's go and get you out of that and just move that money over and defer those taxes.
And just advise your clients, if a client is selling a property, let's get back to the initial, selling a personal principal residence. If they're selling that property and they're gonna qualify, make sure, just drop the word to them, look, if you're getting a 1099-S on the sale of this property, you need to report it. Make sure your tax preparer reports this thing on the income tax return. Otherwise, in about 18 months, you're gonna be getting a ladder. And people appreciate that type of information. They really do appreciate it. And
You save them some money, yeah.
You're in a very strategic position with these clients to be able to provide that type of benefit to them.
You call that a 1099-S?
Yep.
So we're 1099 employees.
Well, you're a
What's the-
1099 NEC,
Okay,
non-employee compensation.
okay, there you go.
But now, again, you all are all of you are 1099 employees?
Not employees,
We did,
so.
I'm sorry.
Yes,
Contractors?
yes.
So you need to look at what we did for April.
What did you
It's
do?
powerful. She thinks she's paid a lot of money this year in income tax. She doesn't have a clue how much she's saved yet. But I'm gonna tell her. I'm gonna tell her husband too. All right? And if we can do another one of these one day, we might just talk about some of those
Yeah.
business structures.
Right,
Because I'd love to come back over and do this.
yeah,
like an
because I
S-corp
didn't
or
know,
something?
yes.
It's probably a lot more pleasurable for me than it was for you all, so.
No, it's good. It's. I feel like our brain. It's not our thing, so like my brain hurts a little bit, but it was all really good, and I took lots of notes.
I have 2 questions real quick. Can you 1031 across state lines, or does it have to be within the same state?
Oh, you can go across state lines.
Okay.
Yeah, that's not a problem.
Okay. Then can you,
Because the reason is, Marcus, right?
That's Marcus, I'm
Marcus. The
Chandler.
reason is, Marcus, what's your name?
Not Marcus.
Chandler.
The reason is, Chandler, because this is not state law.
Yeah.
This is
Federal.
federal law.
Got it.
Yeah.
Okay. Second question. If you have someone that is going to be building a rental house, and they 1031 into a property that does not yet exist. If they can buy the land
Under
and build it, or,
All
yeah.
right, what you're doing, you're actually buying unimproved, you're actually exchanging for unimproved property, is what you're doing.
So what if it's partially improved? The structure?
It's okay,
Okay.
because you're gonna be adding to the cost
Yeah.
as you continue the building on it.
Okay,
So everything still works, you're just gonna be increasing your basis in it,
okay,
yeah.
perfect.
Can I talk to you after everybody?
Pardon me?
Can I talk to you after everybody?
Sure, sure,
She has a
absolutely.
personal scenario. Thank you so much.